Have you ever wondered why some people stay calm while the entire market is panicking? Why do experienced investors see opportunity where everyone else sees disaster? And why did one man write a book nearly 80 years ago that is still considered the greatest investment book ever written? The answer is simple. Because while markets change, human nature doesn't. Fear, greed, hope, impatience. These emotions have been driving financial markets for centuries, and they'll probably continue doing so for centuries to come. That's exactly what Benjamin Graham understood better than anyone else. Known as the father of value investing and the mentor of Warren Buffett, Graham didn't become successful by predicting the future. He became successful by understanding how people behave when money is involved. His book, The Intelligent Investor, isn't about getting rich quickly. It's about avoiding the mistakes that keep most people from ever becoming wealthy. And surprisingly, those mistakes have very little to do with intelligence. Before we begin, if you enjoy learning timeless lessons from the world's greatest books on business, investing, and personal growth, make sure to subscribe. Every week, I break down powerful ideas that can help you make better decisions and build a better future. Now, let's begin. Imagine two investors. Both have the same amount of money. Both invest in the exact same companies. 10 years later, one has built a fortune. The other has lost most of his savings. How is that possible? The difference isn't the market. It isn't luck. And it isn't intelligence. The difference is behavior. According to Benjamin Graham, successful investing is far less about finding the perfect stock than it is about controlling yourself. That's because the biggest enemy of an investor isn't inflation. It isn't recessions. It isn't even market crashes. The biggest enemy is the person staring back at you in the mirror. Think about what usually happens during a market crash. The news becomes overwhelmingly negative. Headlines predict economic collapse. Prices fall day after day. Everyone seems to be selling. Fear spreads everywhere. At that moment, most people convince themselves that selling is the safest decision. Then, months or years later, when markets recover and prices reach new highs, those same people suddenly become confident again. Now they start buying. Without realizing it, they have done exactly the opposite of what successful investors do. They sold low and bought high. Not because they lacked knowledge, but because they allowed emotions to control their decisions. This is one of the central ideas of the book. The market constantly tests your emotions. Every day, it asks the same question. Will you follow the crowd or will you follow your strategy? To explain this idea, Graham introduces one of the most famous characters in investing history, a fictional business partner he calls Mr. Market. Imagine you own part of a successful company with a partner. Every morning, your partner knocks on your door and offers to buy your share or sell you his. Some days, he's incredibly optimistic. He believes the future will be amazing. On those days, he offers ridiculously high prices. Other days, he's terrified. He thinks everything is about to collapse. On those days, he's willing to sell at unbelievably low prices. Now imagine something important. You are never forced to accept his offer. You can ignore him completely. Tomorrow, he'll come back with another price. That's exactly how the stock market works. The market gives you prices every single day, but it never forces you to act. Successful investors understand that prices and value are not the same thing. A company's stock price can change dramatically in a week. The actual value of the business usually doesn't. Imagine owning a small bakery in your neighborhood. If someone offered to buy your bakery today for $1 million and tomorrow another person offered only $500,000, would you suddenly believe your bakery had become half as good overnight? Of course not. The ovens still work. Customers still arrive every morning. The recipes haven't changed, only the offer changed. Yet in the stock market, people react as if price and value are identical. They celebrate rising prices even when businesses haven't improved. And they panic over falling prices even when the company remains fundamentally strong. That's why Graham encourages investors to think like business owners instead of traders. When you buy a stock, you're not buying numbers on a screen. You're buying part of a real business. And businesses should be judged by what they produce over time, not by today's headlines. Another powerful lesson in the book is something Graham calls the margin of safety. Imagine you're driving across a bridge that can safely support 10 tons. Would you choose to drive a truck weighing exactly 10 tons across it? Probably not. You'd want a margin of safety. The same principle applies to investing. Nobody can predict the future perfectly. Even great businesses can face unexpected problems. That's why intelligent investors avoid paying full price whenever possible. The more room you leave for mistakes, uncertainty, and unexpected events, the better your chances of long-term success. This simple idea has protected investors for generations. Because investing isn't about being right every single time. It's about making sure that when you're wrong, the damage is limited. Another mistake Graham warns us about is confusing investing with speculation. Today, buying and selling stocks has never been easier. With a few taps on a smartphone, anyone can trade instantly. Unfortunately, that convenience has encouraged many people to behave like gamblers instead of investors. They chase the hottest trends. They buy because everyone on social media is buying. They sell because everyone else is selling. Their decisions are based on excitement instead of analysis. An intelligent investor behaves differently. Before buying anything, they ask simple questions. Does this business make money? Does it have a competitive advantage? Can it continue growing over the next decade? Is today's price reasonable? Notice that none of these questions depend on tomorrow's stock price. They depend on the quality of the business itself. That's the mindset Graham wants us to develop. Perhaps the greatest lesson in this book is patience. Modern society rewards speed, instant messages, instant deliveries, instant entertainment. People want instant profits too, but wealth rarely works that way. The greatest investors understand that time is one of the most powerful forces in finance. A great business needs years to grow. Compound returns need years to multiply. Patience isn't simply waiting. It's trusting a well-designed process even when results aren't immediate. This is exactly why Warren Buffett once said that the stock market is a device for transferring money from the impatient to the patient. That single sentence perfectly captures the spirit of this book. In the end, the intelligent investor isn't really about stocks. It's about decision-making. It's about learning to stay rational when everyone else becomes emotional. It's about understanding that opportunities often appear when fear is at its highest. And it's about realizing that true investing isn't a race against other people. It's a lifelong battle against your own emotions. Because markets will always rise. Markets will always fall. News will always create panic. Experts will always disagree. But the investor who stays disciplined, thinks independently, and focuses on long-term value will always have an advantage over those who simply follow the crowd. That's why this book has remained relevant for generations. Not because it teaches you how to predict the market, but because it teaches you how to master yourself. And in investing, that's often the greatest advantage of all. If you enjoyed this summary and want to discover more timeless lessons from the world's greatest books, don't forget to subscribe and turn on notifications so you never miss the next video. Thanks for watching, and I'll see you in the next one.